Welcome to Talk the Walk. I'm Sarah Wong. Recession, a once daunting word, has become farther from impossible as central banks in the West scramble to tame inflation with aggressive interest rate hikes. What is the fallout of a prolonged economic downturn, and what does it mean for investors, consumers, and our daily lives? And is there a different story in Asia from the rest of the world? Clifford Bennett, chief economist at ACY Securities, returns to Talk the Walk to help us break it all down. Clifford, so good to see you. Thank you for being here.
Please, Sarah. Thank you for having me on your show.
I want to talk about Australia's economy in just a moment, but first, a 75 basis point rate hike by the U.S. Federal Reserve and the aggressive posture was subsequently adopted by central banks all across Europe and England. Is it too late, and is the recession inevitable at this point?
That's a great question. Yes, the Federal Reserve is about 12 months too late. That's a very abysmal performance from the Federal Reserve indeed, and probably its worst performance for many decades. Remember, in the early stages of this, the Federal Reserve kept highlighting how inflation would be purely transitory, would calm down, and everything would be okay. And that obviously hasn't been the case. And at the time, we were forecasting exactly this, actually, that the Federal Reserve would wake up far too late and then be forced to raise interest rates far more aggressively than it would otherwise have needed to do so. And that's why we're going to see, unfortunately, this recession scenario play out in the United States, because consumers, business managers alike, are all going to be squeezed by both resiliently or sustained ever higher food and energy prices for the foreseeable future, plus rising interest rates that not only impact businesses and borrowers in general, but could lead to a cycle of mortgage stress that could be particularly damaging to the US property market. So they're going to be feeling higher prices, particularly at the bowser, the petrol pump, and higher interest rates all at the same time. So it's a very difficult situation now for the US economy, because it was really just coming out of the stimulus boom, which was quite artificially generated, and it is going to have some natural hangover impact from those stimulus measures in any case over the next 6 to 18 months. And all of these other factors now just exacerbate that situation to a point where a recession seems almost unavoidable for the United States.
Do you think what we're facing right now is a distinct crisis, unique in its terms, or we can find lessons in history?
I think it is particularly unique because in history, usually inflation has been demand-driven. It's been situations of overheating economies, whereas on this occasion, the inflation really both out of COVID and the supply chain disruption there, and more recently out of the loss of supply out of Ukraine and Russia and the refusal of supply, particularly out of Russia, it is a different animal when it comes to inflation this time. And one of my deepest concerns, which I've spoken of at length for some time, is that this will not be a form of inflation that raising interest rates actually tackles. In other words, they're going to be raising rates ever more aggressively, but it's not going to have the impact on inflation that they would hope.
And why do you think that the Fed get the risk assessment so wrong this time? And is it incompetence, or is it, simply complacency?
I think it's a little bit of complacency and getting lost in the idea that they, the Federal Reserve, with all their resources, knew better than anyone else. I don't think I'm alone, but we would certainly be among the first in the world who are saying that the Fed, and similarly the RBA in Australia, but the Federal Reserve would have to start raising interest rates about a year ago. And we advocated that if they started raising interest rates in what was then a strong rebounding economy, and they started raising rates gently, then we wouldn't be faced with these sort of crisis rate hikes to head off runaway inflation. Now, I'm not saying it would have totally solved the problem, but we'd already be up at 2.5%, 3% Fed funds rate. We wouldn't need to be raising rates just at the moment. So I think it's complacency. I think it's a little bit of incompetence. I mean, I call what I do look out the window economics. You have to apply common sense to what's going on in the world today, and you can't apply ancient textbook theories and formulas to what is happening with any particular economic indicator. You really have to think on your feet. And I'm not sure if the Federal Reserve has gotten itself into position to be able to do that.
Now, you've categorized this cycle we're facing right now as unique in its, supply side problems. Now, some experts predicted that the Russian-Ukraine war could last for years, even up to 10 years or so. How bad of a situation are we staring down the road? Shall that come true?
Yeah, no, I think that's probably an exaggeration on the 10 years. Let's hope so, because it's a tragedy every day there for the people in Ukraine. And also for some parts of Russia and some parts of Europe where, business opportunities have been completely disjointed, if you like. But I've said from the outset that I thought this war, at first I thought it was going to be a 2 to 3 week. We all thought Russia had the superior force. But once we realized they didn't, in fact, have the military superiority we thought they did, I've been saying that I think this war will extend into 2023, and that could extend into 2024. But I'm hoping towards the second half of 2023, we will see some stabilization, if you like, of the front line. And that front line is likely to become an annexed area by Russia, which will be very difficult for anyone to undo in the future. But on the positive side, it may lead to a lasting peace. So that's my outlook for the conflict. But that's still 12 to 18 months off. And in the meantime, the energy crisis in Europe is not resolved, and things look a little bit dark, literally, perhaps, on the power front for the European economy.
Now, talking about energy crisis, and we're talking, you've predicting that the recession would come very, the impact would be severe. And I wonder what would it, because we touched on the topic of recession a little bit in our last interview, and I wonder what would a recession look like for the more vulnerable economies?
Yes, I think we've got to consider the idea that recession in Europe and the United States at the same time coming on top of a China situation where the economy is slow. But I always thought that China would be touch and go, and we'll get to Asia in a moment, I guess. But I think there will be a flow-on effect to many poorer countries in the world, but that flow-on effect is going to be hyperinflation in terms of food and hyperinflation in terms of energy. Because one of the things very few people are speaking about at the moment is the idea I've put forward that at some point national governments are going to recognise that this is an ongoing difficult situation, and they need to secure higher levels of energy reserves themselves. And if we get into a little bit of a battle, if you like, conflict for energy reserves, particularly LNG and for oil, those prices still have a lot higher to go. And that's going to be also because we're not just talking here about higher prices. For the poorer countries and poorer segments of many countries around the world, unfortunately, they will be the hardest hit because not only do they have trouble dealing with the higher prices, but also actual physical shortages of what is required. So it is a very difficult situation confronting some of the poorer countries in the world. And we've already seen some warning signs on that front in places like Sri Lanka, where stress levels are rising.
Yeah, well, talking about, the impact on the economy, we're looking at, the U.S., the Wall Street, U.S. stock market entered a bear market for the first time in a very long time. And I wonder, looking at the market turmoil across the board, what would you say to those who, who maybe say that's to be controversial, but suggesting that now it's a good time to buy the dip. What would you say to those analysts?
Are you baiting me, Sarah? The buy the dip people have been wrong all year. I wish they'd been right, part of me. The other part, the investment part, has worked quite well being a bear this year. I like how people have these magical numbers where it's 20% and now suddenly the US stock market is in a bear market. It has been in a bear market since the very first week of January, where it opened with a euphoria and made those momentary new highs and then began to fall back in on itself from that very point. And I highlighted then that they could well be the highs for the year. So the market's been in a bear trend for nearly 6 months now. And people are still trotting out the same idea, a little bit like in the crypto space. Oh, it's a great level to buy. Well, unfortunately, it may not be. I hope I am wrong, Sarah. It'd be nice to be wrong here because we're starting to move into territory where not only are stocks falling because there is a recession, but too severe a decline in equity and other asset classes could well deepen the recession for the United States and other countries around the world. But I do think we have to consider, I always thought this would be a 6 to 18 month downward correction in equities. But I did highlight from the start of the year, there is an outside chance, and that outside chance seems to be getting stronger now, of this actually being a 3 to 6 year corrective period in equity markets, particularly Western equity markets. And I think people don't need to sort of rush for the exit just on that idea, but they do need to consider it in their investment portfolio as a possible scenario that's becoming stronger. And that's because what we're seeing is not just these economic fundamental headwinds, but we're seeing them come at a time when sentiment was very bullish. We had the widest participation of the general public in the share market in history. We've had the creation of new novel investment tools and products in the crypto space and other areas. And everyone's been a little bit involved in what I like to call a tulip bulb type frenzy. And people may not remember, but once upon a time in Holland, the humble tulip bulb was valued at more than the average price of a home. That's how excited people got there. So that's what that reference is. But I think what we're seeing is very severe economic headwinds arriving unexpectedly to many people at the same time that they were overly invested and leveraged long in investment products. So it's a confounding sort of spiral of those forces to the downside at the moment. And that's why even after the 20% fall already seen in US equities, there could be further downside.
All right, well, we'll definitely keep a very close eye on that. More insight from Clifford Bennett, Chief Economist at ACY Securities. After the break, we'll be back in a moment.